Scene script. Have you ever wondered how some investors consistently outperform the market? The answer might lie in their investment strategy, specifically active investment. Let's dive into the world of active investment strategy, a concept that's as dynamic as it sounds. See, investing isn't always about sitting back, relaxing, and letting the market do its thing. Sometimes it's about rolling up your sleeves, getting your hands dirty, and taking an assertive role. That's exactly what active investment is all about. Picture a chess match. It's not enough to just know the rules, right? To win, you need a strategy. You need to anticipate your opponent's moves, react to changes, and seize opportunities as they come. The same applies to active investing. It's a hands-on approach where the investor or a fund manager makes specific investments with the goal of outperforming an investment benchmark index. Think of the benchmark index as the measuring stick. It's what active investors compare their performance against. It could be the S&P 500, the Dow Jones Industrial Average, or any other market index. The goal isn't just to match it, but to surpass it. That's the essence of active investing. But how is this achieved? It involves a lot of research, analysis, and decision-making. Active investors study market trends, analyze company financials, and stay updated on economic news. They are constantly on the lookout for undervalued investments or ones that show promising growth potential. It's like being a detective, always hunting for clues to make the best investment decisions. But remember, with great power comes great responsibility. Active investing might offer the potential for higher returns, but it also involves a higher degree of risk and requires more time and expertise. It's not for the faint-hearted, but for those who dare to take the reins of their investment journey. So to put it simply, active investment strategy is all about making calculated decisions to outpace the market. It's about being proactive, staying informed, and making strategic moves. It's about playing the game of investments, not just watching from the sidelines. Is active investing the right strategy for you? Well, that's a question only you can answer. Now that we know what active investing is, let's delve into the key elements that make it tick. Active investing is a bit like being a detective. You're always on the hunt for clues that can lead to profitable investment opportunities. The first key element of this strategy is research. In-depth, meticulous research is fundamental in active investing. You're not just looking at the numbers, but also at the story behind them. You're analyzing company reports, industry trends, economic indicators, and even global politics to understand where the market might be headed. Now imagine you've found a promising company to invest in. You've done your research and everything looks great. But when should you buy? That's where the second key element comes in. Market timing. Active investing isn't just about what you invest in, but also when you do it. The goal is to buy low and sell high. Easier said than done, of course. It requires a keen understanding of market cycles and a good dose of patience and nerve. But what about the risks? That leads us to the third key element, the risk-return trade-off. Every investment carries a level of risk. The trick is to balance that risk against the potential return. In active investing, you're often taking on more risk in the hope of achieving greater returns. You may choose to invest in a startup with huge potential, knowing there's also a chance it might fail. Or you might decide to sell a stable but slow-growing stock to free up capital for a more lucrative opportunity. These three elements, research, market timing, and risk-return trade-off, are the gears that drive the active investment machine. They're interconnected, each influencing the others. Mastering them requires time, effort, and a willingness to continually learn and adapt. Remember, an effective active investment strategy hinges on diligent research, strategic timing, and understanding the balance between risk and return. As you venture into the world of active investing, keep these key elements in mind. They'll be your compass, guiding you through the ups and downs of the market. As with any strategy, active investing comes with its own set of pros and cons. Let's dive right into it, shall we? First, let's talk about the high reward side of the coin. The active investment strategy is often enticing because it offers the potential for higher returns. Unlike passive investing, where you're essentially riding the market waves, active investing is all about making informed decisions to outperform the market. It's like being in the driver's seat of a supercharged sports car, navigating the twists and turns of the market with precision and agility. When done right, active investing can lead to significant gains. making it a potentially lucrative strategy for those with a keen eye for investment opportunities. But like driving a sports car at high speeds, active investing isn't without its risks. This brings us to the flip side of the coin, the cons. The most significant of these is the risk of human error. Even the most seasoned investors can make mistakes, and in the fast-paced world of active investing, one wrong move can lead to substantial losses. It's important to remember that while the potential for high returns is there, so too is the potential for significant losses. Another drawback to consider is the higher costs associated with active investing. This strategy often involves frequent buying and selling of securities, which can rack up transaction fees. Additionally, if you're using the services of a professional fund manager, their fees can also eat into your returns. Lastly, active investing can be time-consuming. It requires continuous monitoring of the market and making frequent investment decisions. This can be a burden for those who don't have the time or inclination to be constantly engaged with their investments. In conclusion, the active investment strategy can be a double-edged sword. It offers the potential for high returns, but comes with its own set of risks and costs. While active investing can potentially bring higher returns, it's important to be aware of the risks and costs involved. It's essential to understand your own risk tolerance, financial goals, and investing acumen before deciding if this strategy is right for you. So, how does active investing compare to its counterpart, passive investing? Well, let's dive in. Active investing is like being the captain of your own ship on the rough seas of the market. You're at the helm, making decisions and trying to navigate the best course to reach your destination. You're trying to beat the market to outperform it. How do you do this? By buying and selling securities based on research, analysis, and your own judgment. It's a hands-on approach that requires a significant amount of time, knowledge, and effort. Now let's consider passive investing. Imagine you're on a cruise ship. You're not the captain, you're a passenger. You're going along with the current, riding the waves of the market wherever they take you. The goal here isn't to beat the market, but to match its performance. This is achieved by investing in index funds or ETFs that track a specific market index. It's a more hands-off approach that doesn't require the same level of involvement as active investing. So, which is better? It's not a question of better or worse, but rather what fits your investment style and financial goals. Active investing can potentially generate higher returns, but it also comes with higher risk and costs. You're betting on your ability to pick the right investments and time the market correctly. It's like playing chess with the market, and let's face it, the market is a formidable opponent. On the other hand, passive investing is less risky and less costly. You're not trying to outsmart the market, you're simply going along for the ride. But this also means that your returns are limited to the performance of the market. In the end, whether active or passive investing suits you better depends on your financial goals, risk tolerance, and investment knowledge. That wraps up our discussion on the active investment strategy. Over the past 10 minutes, we've taken a deep dive into the active investment strategy, unpacking its key elements and weighing its pros and cons. We've also compared it with passive investing, shedding light on how these two strategies differ and how they can complement each other. We've learned that active investing is not a one-size-fits-all approach. It requires time, knowledge, and a keen insight into market trends. It's a hands-on strategy where investors, or their fund managers, make specific investment decisions with the aim to outperform the market. From stock picking to timing the market, active investing involves making calculated decisions based on thorough research and analysis. But it's not all rosy. With the potential for higher returns comes higher risk and higher costs. Active investing requires more time and effort, and it often incurs higher fees due to frequent trading. It's a strategy that demands commitment and a tolerance for risk. We've also seen that active investing stands in contrast to passive investing, which is a buy-and-hold strategy that aims to match, not beat the market. The choice between active and passive investing is not a binary one. Rather, it's about finding the right balance based on your financial goals, risk tolerance, and investment horizon. So where does this leave us? Well, the journey of investing is as unique as you are. It's about understanding your financial goals, assessing your risk tolerance, and choosing a strategy that aligns with these factors. It's about being an informed investor, one who knows the ins and outs of their chosen strategy and is prepared to navigate the ups and downs of the market. As we conclude, remember there's no right or wrong way to invest. It's about finding a strategy that works for you, one that you're comfortable with and that aligns with your financial objectives. Remember, the key to successful investing lies not just in choosing the right strategy, but also in understanding how that strategy aligns with your personal financial goals. Happy investing!